Welcome to the NEF Capital Advisors webcast. My name is Joy Milkowski, and I'm here today with Clark Griggs, head of Griggs Wealth Management and wealth manager. Clark, I'd love to just hear more about your background and experience as a wealth manager to get us started.
Joy, thank you, and it's a pleasure to be here. I've been in the financial services business now for over 20 years, and for the past 15 years, I've had a very specific focus on business owners. Rather specifically, helping business owners prepare their businesses for growth and correspondingly also transition those businesses for sale when the timing is right.
So within your business, how are business owners different than traditional clients? What specific issues are they facing?
Well, business owners are a very unique breed. They live their businesses 24 hours a day. Quite often, their businesses are their most important asset. And it's a challenge for them at a certain point to determine when to sell. And more specifically, after they sell, how do they maintain their lifestyle and continue to enjoy life and move on?
Well, and piggybacking on that, that's what we're here to talk about today is how much money a business owner really needs to be financially free. Because, right now, business owners are trying to decide, is it time to sell or do I grow the business? How do you help make that determination and what factors are involved?
Well, I've had the pleasure of working with both you and NEF in the past in terms of identifying when the right time is to sell. We talk a lot about metrics. We know very specifically to revisit that when the stock market is at new highs and is in the latter part of a bull market, it's also one of the better times to sell a business. So once you take that data into account, the next decision is to decide what is enough. And we hear a lot of different conversation in financial circles around your number and what's the nest egg number. There's a great book out called Your Number. And rather specifically, it's a challenge because many business owners don't understand that after the business sale, they may actually have an asset that generates less income than they would while still owning the business. So quite often in retirement circles, we will say out of a nest egg number, if you wanted to simply draw down on that number, you would need between 3% to 5% as a sustainable withdrawal rate over time. However, a business quite often has a much higher withdrawal rate when you look at a salary that an owner takes in addition to distributions, other things that may come out of the business. So many business owners are rather surprised and shocked when they find out that actually they don't have as much money post-sale and after tax as they thought they did.
So are they not taking into account things that they used to expense or, is that all part of it?
Most definitely. So you have hardline expense items that typically were absorbed by the business that now you're paying for directly or on an after-tax basis, right? So you have to have portfolio income now cover a lot of the things, whether that be meals and entertainment, what have you. And so yes, there are specific tax advantages that owners have and deductions that they can use, right, that post-sale are no longer there. Another thing that I think is really critical, so when we get into the nuts and bolts of how to arrive at that number and what to do, a lot of the time what we need to start with is cash flow. We both know, and all of us know as business owners, that cash is the lifeblood of a business. Frankly, it's the lifeblood of a financial plan. So it's very critical to understand what are my real income needs. And what does it take for my family to run? What does it take for me to enjoy life, to have quite often vacation, travel, things of that sort increase post a business sale? And our unique numbers tell us, Joy, also that many business owners go on to actually buy another business or get involved in another transaction or they buy real estate. So when you're running those numbers as well and looking at cash flow, you really need to make sure that you have a very clear strategic plan as to what the rest of your life may look like.
So not just thinking pre-sale, but definitely taking the time to think post-sale.
Most definitely. And post-sale, it's interesting as well. What we find is that there's a certain restless factor with many of our owners. They'll be comfortable for a year or so. They'll get some things done. They'll visit places they want to see. They'll see extended family, grandchildren, or whatever. And then the conversation is, how do I define myself? What's my purpose? And I'm ready to potentially get back at something.
So let's shift focus on the terms of any given sale and how that affects the number.
So one of the things that's a general given, I was just tearing apart some multiples, and we know that typically in expansions, we get higher multiples for businesses. And we also have quite often reasonable deal terms in terms of earnouts. So, in a market like this, we may not necessarily have to have a 5-year earnout or a 7-year earnout, and we'll get a higher multiple. But as the economy shifts and changes, often that multiple goes down that we can get for the business, and you're working longer to transition it.
So what are we seeing in terms of the market conditions now? Still favorable for the owners?
Still very favorable for the owners. One of the things that is a slight change right now is that we are starting to see that interest rates probably will go up in the second half of the year. So if the cost of capital increases for a private equity group or even a strategic buyer, one of the things that will happen is you'll start seeing those deal terms change a little bit. You'll see either earnouts increase, you might see those multiples decline somewhat. So, again, we always talk timing. It's an incredibly good time right now to look at selling your business.
So with the cost of capital going up, does that also mean that maybe some opportunities might have to wait?
Well, that's a real challenge, and it's a great point. One of the things that I was reading today, I was reading on a very high level. I was listening to an analyst talk about the fact that we think the cost of capital will stay down for some time. We won't see a meteoric rise in capital. But what it does is we need to realize as business owners that we do follow a cycle, and that cycle could be 5 years. So if you miss your opportunity now, you could literally be in another business cycle before you're prepared. That happened to several of our clients in 2007. We were teed up in 06 and 07 to go to market. 08 hit us, and before we knew it, capital dried up. Deal terms got incredibly limiting, and as a result, people sat on their businesses another 5 years. And we know also that demographically, given our numbers, that we do have a larger number of businesses for sale.
Okay, so basically, if business owners are thinking about it right now, there's a chance if the timing's not right, they'll actually be, in that business for the long term rather than for the short term.
Right, and the question is, do you have the energy? Do you have the emotional passion to keep it going? Business owners don't have the energy to continue their enterprises. There's a certain level of fatigue that sets in. As we look at growth drivers and putting together teams and doing all the things that we need to do to prep for sale, that actually requires a certain amount of energy and engagement. And an owner may get to the point where it's just too much.
So we're, several years into a bull market now, and are we starting to see a shift?
There are some slight shifts that are occurring that I'm concerned about, Joy. One of them is that we've had some profit guidance from our S&P 500 companies. It looks like we may have slowing growth. We're starting to see it in our markets. So we've got the stock market up 3% to 4% for the year, but a lot of investors are moving their money overseas, and those markets are up 8 to 10%. Also, I watch what happens with interest rates in terms of whether or not we will see rates go up. Bonds year to date are up about 0.4%. They've been as high as up 2% last quarter. So we are starting to see some sea changes here, I believe, in the marketplace, and that in turn should really serve as a great flag for our business owners.